cryptography you think of when you have a key. So it's before with symmetric key, I trust Robbie with a key that we share. And now I have to trust that Robbie keeps control of his key and doesn't let anybody else see it, and that I also have complete control of my key. Because anybody that finds that key is going to be able to encrypt or decrypt whatever we send to each other. But so you can think of that as traditional locks today. When you go and you unlock your door, you have one key. That key can be cloned. You could get another key cut or something like that for your door, and it'll unlock just fine. That's kind of like symmetric key. But with public key cryptography, what we're able to do is we are able to have a public key, which we share with everybody, and we have a private key that we keep to ourselves. And so I don't have to trust somebody else to hold on to or keep secure the key. I just have to trust myself and make sure that I'm the only one that can secure it. And so the best way that I can think of for public key cryptography to understand it with the lock analogy, like the door that I just explained earlier, is with public key cryptography, you have public key that can open one way the door or a lockbox, for example. So I send right up here, we have Alice and Bob, right? Let's say I'm Bob and I send Alice my public key. And what she can do is there's a box outside of my door that people can place stuff in. And so Alice walks up to my door. She has a package for me. She puts it into this lockbox. And with the public key, she's able to lock the box. But she can't unlock the box. Nobody can take the public key and decrypt what was encrypted. So the key for a public key turns one way and a private key turns it the other way. So even though everybody in the world could conceivably have my public key, they can still only lock the box and they can't unlock it. I have to be the one to go walk up to the box and unlock it myself with my private key. So really important things are that I don't have to trust somebody else, and also for application in digital signatures. So digital signatures are essentially when it's a claim that I've actually sent something or something has come from that. When I send a message to Robbie, Robbie's able to verify that that actually came from me and not from somebody else. And the way this happens is just like the opposite way of the lockbox. So I can send in, I can encrypt something with my private key, send it to Robbie, and he can decrypt it with the public key. And if I send a message alongside that of the contents of the message, he's able to decrypt and check that the message that I sent is exactly equal to the message that I wrote and signed with my private key. So we're able to verify that people have the messages that were sent were actually from those people. The next thing that we want to talk about is hashing. So hashing is essentially, it's known as a one-way function. And so with traditional functions that we have in math, for example, like up here, if we have y and x as variables, we plug in x, we find y, we could easily get x back. It's super easy to do. I mean, anybody can do that. But with one-way functions, if we send something into a hash function, anything that comes out, it's not able to be traced back or reversed. It's absolutely impossible. There's no way anybody could do that. Another thing is if I keep putting the same thing into this hash function, it's going to give me the same thing output every single time. So you can't go back, but you're sure that anything that you put into that function is going to be the same as what somebody else had put into that function if the hashes are the same. And it's completely random. Nobody knows what the hash is going to look like of a certain object until you actually put that object into the hash function. So as you can see down here, we have hello that has a certain hash, a certain hash, hello, a. There's no pattern to it or anything like that. Okay, now let's get into the digital currency specifics. And for this, just right off the bat, I want you to think of, if you don't know what the blockchain is, I do want you to think of a blockchain as simply a verified record of transactions. That's all it is right now. And you'll see why I tell you to think like this. So in the Bitcoin network, or in the Bitcoin ecosystem, there are 3 important roles that people have that are part of the Bitcoin network. So we have the users like you and me who buy, who speculate, who trade. They're the ones that give value to cryptocurrencies. It's really just all about supply and demand. I mean, speculative value for the most. Then we have the miners. The miners are computers, but also computers set up by people that essentially create and verify the transactions in Bitcoin. So I'm sorry, let me step back for a second. What miners do is they take the transactions that have been pushed out to the network, and they do necessary work onto all these transactions. And this work is used to secure the blockchain. And I'll get much more into miners, and it'll be clear later. And then we have the last part is our nodes. And nodes are just they're computers, again, that are set up by individuals. And what these do is they just keep track of all the different transactions that go into the network are created. So whenever I create a transaction or send somebody Bitcoin or cryptocurrency, that transaction gets broadcast to all the nodes in the network. So the first thing and most and that I want to talk about are wallets. So wallets, if you've dabbled in cryptocurrency at all, you have a wallet. It's really just an interface for managing your public and private keys. So wallets, whenever you create a wallet that you have ownership of your private keys for, that we were discussing earlier, that aren't on some centralized exchange, for example, well, when you set it up, you're going to be given these words that act as your master private key. So these words will unlock your wallet and all the funds in it, basically. So you have to make sure that these words are secure. But this master private key is used to derive the addresses that we're going to see next. So what are addresses? So addresses are essentially whenever I would need to send cryptocurrency to somebody, they need to present their address to me, a QR code or a long string, for example. And the wallet, like I said before, the wallet manages these public and private keys. And the master private key is like all the public and private keys for addresses are derived from the master key that I just showed in the seed. So each address sort of acts as a public key and private key pair. And anytime you're trying to, you need an address to send somebody, to send mail to somebody, I need to send it somewhere, right? So those are the functions of an address. Now let's get into blocks. So blocks, whenever I make a transaction, this gets pushed to the nodes, which I'll get into when we talk about transactions. And that's by far the most complicated thing that we have to talk about today. But blocks are essentially just filled with a bunch of transactions. And then the miner, they take all these transactions, put them into a block, do the necessary mining work that we'll talk about in a bit to verify the transactions in that block. And then once that block is verified by the nodes, it gets added to the blockchain, the verified record of transactions. And any transactions that occurred in that block that the miner chose are then actually executed. So that's kind of where the block part of the blockchain comes in. So now let's talk about mining. So mining's a bit complicated. It's one of the more difficult things we have to talk about. But the purpose of mining is to create new Bitcoin, as well as secure the network and put in computational resources to secure the network. So what do I mean by this? When a miner needs to create a block, what they do is they fill the block, which is usually a cap size, about 1 megabyte in Bitcoin. It varies in other cryptocurrencies. What a miner tries to do is they fill the block with transactions, and then they take about previously of that block full of transactions, the hash of the previous block that had just occurred, that's the last block in the blockchain, and some random data. And then if the resulting hash of that comes out to to some sort of form, then the work that they put in is valid. So that was a lot of words, but it probably made absolutely no sense. So let me break it down a bit. When a miner, this string down here that we're looking at is the resulting hash that it needs to follow, right? So when somebody is when somebody takes the hash of a block, like I just explained here, take the hash of the previous block, the current block hash, and random data, and the resulting hash is conforms to lower than a number, then that means that they've verified it. Because when you take the hash of some random data, you don't know what's going to come out, right? So when I take a hash of something, the only way that I can get a result that fits this formatting is if I do a bunch of different hashes over and over and over and over until I finally find one I finally find a random data parameter that will result in a hash that has this amount of zeros, or this threshold. So the way this ties into Bitcoin is Bitcoin, if you know a decent amount, or maybe not even that much, has what are called 10-minute block times. And so when the way they get at 10-minute block times is the total amount of people that are contributing their computation power towards the network, the amount of hashes that they can do every second, is something that's able to be known by the Bitcoin network. Everybody knows how much computation work is going into mining. And so what you can do is you can adjust what this threshold is for the resulting hash to make it so that people that are publishing blocks are able to they'll come in every 10 minutes. Can I get some questions on this? I feel like I'm not explaining it correctly, and I want to make it clear. Yes, excellent question. So these zeros, so in binary, everything is zeros and ones, right? So these leading zeros show that the hash is conforming to a specific, it is below a certain threshold. So if I'm going to do one hash, this could be totally random, right? This could be 1, 2, 3. This could be anywhere from 1 to F, so hexadecimal. So if I'm hashing something and I see that there's a 0 in front, then I know that for this first significant digit, I have put in one, for every one hash that I find of this first significant digit, there's going to be 16 people that made hashes that weren't with a leading 0. So if you compound this over and over and over and over, it'll show you how small of a fractionally insignificant the probability is to find one hash that conforms to this. So in that way, we are able to make sure that the people that are mining are able to create new blocks every 10 or so minutes. Because yeah, so this is what people refer to when they talk about the difficulty of mining. It's how difficult is it to, what's the probability that you're going to find a hash that's going to be that's going to fit below some threshold. And in this case, it's 1/16 times 20 or something. I mean, the amount of computation power that's put into the Bitcoin protocol is absolutely wild. Other questions? Yes. So mining is used to to create new Bitcoin. So when I am a miner and I up here, like I take the hash of the previous block, the current block, and the random data. If that result is this this conforms to this hash down here, I am able to, in that same block, make a transaction that says, oh, I'm able to get 25 new Bitcoin, or right now it's 12.5 new Bitcoin. And that's all based on the code of Bitcoin. Essentially, the reward that you're able to get from creating a new block is halved, and it's on a log scale, so that we will always have Bitcoin, or not always, until 2140, we'll have new Bitcoin that are being created and put into the network. So mining, its purpose is that people have expended the electricity to run all these computations. And because they've done that, they are incentivized to make sure that each transaction is valid. So mining incentivizes people to put the correct transactions in there. It incentivizes people by issuing new Bitcoin, and it contributes to the security of the network. Yeah, these numbers and letters are a hash, and it's completely random. So anything that I put in there, it could turn up like this. It could be something completely random. Anything you put into a hash function is going to appear to be random. Okay.
Just to add on that too, what's that thing that allows to mining the golden pieces, centralized, distributed? Anyone can get gold for free and just make gold in thin air, or find gold out of thin air. They would not be mining, right? And I think that gold would lose much of value due to the fact that no one has spent decent value of. And so what Bitcoin does is that it's created, yes, decentralized as well. And since the verification of all transactions takes seconds, protocol requires every miner spend some resources, some electronic electrical to basically show, like, prove that they have expended work to verify some X block being like some X amount of blocks, right? So that's how I like to see it. And miners are being incentivized to mine, because if they solve the block, then they receive a block. So no one, like, unless more than 51% of the network lose to say this person should get more, Bitcoin to certain software change, then these systems compromise. But if there is collusion under that 51%, then the software is when the software determines how much Bitcoin.
Yeah, that was a pretty good explanation.
It's not all too much, but with technology. Like in those cases where in the real world, where something is fully possible, how do you compromise the fact that energy power required to one mine Bitcoin is met without doing energy expenditure? How do we compromise on the fact that possible part of the software could involve
Yeah, I mean, those are definitely interesting conversations that you can have about the effects of forks on the security of a network. But I'd really like to tie it back to just the basic principles that underlie the technology. But I'd love to discuss with you afterwards what the implications of forks could be on things like that.
This right here. This is basically this is like this we're talking about so these miners try to do is try to find
Exactly. Okay, so
when they're able to do that, then they're rewarded watching.
No. When a miner successfully solves the puzzle and the block is added to the blockchain, then in that block, the miner included a transaction that says to give them Bitcoin that didn't exist before. And so that's where the new Bitcoin comes into play. And I wanted to separate the conversation of nodes until later on, but it's because it's an ecosystem, it really involves all these different players. I'll just throw it in here now because I think it'll add some clarity. So the job of the nodes is when I'm, as a user, make a transaction and I broadcast it to all the nodes. The nodes have a full history of the blockchain. They're able to see exactly who has what amount of cryptocurrency or Bitcoin, for example. And if I didn't have the amount of Bitcoin to send, the nodes would immediately say, okay, no, you can't send that transaction. And I wouldn't be able to send. If the signature that I provided for the coins is not correct, then the nodes are immediately able to say, okay, no, that's not correct. We're not going to let you transact. So these nodes essentially are able to, once they're given some sort of data, they're able to instantly see if that data is legitimate in regards to the network. So when miners are mining, they get the transactions from the nodes, what are called unconfirmed transactions that the nodes is keeping a record of. And then they put that into a block, like I explained earlier. And then they can do this mining operation to show that they've expended the electricity or energy required to mine. A block you can think of, a block is just a big group of transactions. So a transaction takes like about 200, it could be like 200 bytes. And so people are sending transactions all the time. And these transactions go to the nodes that before they're actually incorporated in a block. And then the miners take the transactions that haven't been confirmed in a block yet, and they do the necessary mining to add those transactions to the block. So blocks are just groups of transactions. Nodes are the entities. Nodes are the entities that hold a full record of the blockchain. So every single transaction that's happened, they know the state of the network, and they're able to verify immediately if somebody is trying to fraudulently spend. That's the blockchain, yes.
They're scattered so that, again, you decrease the collision being over groups of malicious. Yeah. So we kind of add off of that. So everybody has the same blockchain. So everybody has the same ledger. So by having everybody have the same exact blockchain accessible through them, makes that what is making up a transaction. So if somebody wanted to go through and say, hey, I suddenly just got 10 million Bitcoin. But it's like, what are you talking about? It's not your history. They're like, oh, you're lying. Everybody has a copy of that. So the nodes just keep track. Yep. Check system.
Yeah, they're able to verify something instantly. So the way that that ties into mining, is miners have to expend all this electricity. And if they were to put some fraudulent transaction in there, then the nodes would be able to see that transaction and say, oh, that wasn't legitimate. And so all the money that they just spent on electricity was wasted. So it's sort of like a game theory type thing where miners are incentivized to include proper and legitimate transactions into their block to add it to the record, the blockchain. Okay, if you want to talk more about this, I'll happily talk with you one-on-one. But moving on, this is probably the most confusing thing, and don't worry about the picture. We're not going to get into the picture, but yeah. So transactions. So now that hopefully you understand what mining is and blocks and addresses are, essentially what transactions are, those are Bitcoin. Those are cryptocurrencies. So what I mean by this is when I send a transaction to somebody, I have what are called unspent transaction outputs. And so if you look at this example transaction here, somebody sent me 0.2 Bitcoin before. Now I have a transaction that is of value 0.2 Bitcoin. Now when I try and send that transaction to somebody else, I want to send 0.1 Bitcoin to Jacob, for example. I have to put in my 0.2 Bitcoin, the transaction that I own, and then what gets output from that is what I'm trying to send, as well as any change that is left in the transaction. So the reason it's like this is so that we can have a simpler way of verifying the blockchain. Because if I'm going to since they're all represented by transactions, it's a standardized approach towards record keeping that the nodes have to keep record of for the blockchain. So that's the best way I could explain transactions if in a short blurb. What all goes into a transaction is the address that you have in your wallet, the private key for that address gets put into the transaction, and this is where the verification comes into play for if I've actually tried to spend my own Bitcoin and things like that. So yeah, there was a lot of information there. I'm sorry that I couldn't portray it as cleanly as I would have liked. If you have any questions, please talk to me directly. But after the meeting. But right now, I think we're going to go with the coin sector topic right now, our part. All right, let's see. Hold on. Any questions about what I decided on? Literally anything I could do, I'll try and explain it a little bit.
When it comes to yes, so you only at least 6 blocks to be ahead. That's friendly with block. Whether it ties more into the kind of ties into force way. I don't want to time Jacob's presentation.
My name is Jacob. Today I will be doing the second segment of the altcoin series, and I'll be delving into the major 3 altcoins that deal with smart contracts, which are Ethereum, Neo, and NEM. First, I'm just going to give a brief overview of what is a smart contract. Smart contracts differ from your regular legal contracts in that they are enforced by essentially code instead of a law. So in a regular legal contract, you have, let's say you want to dispute a legal contract, you present evidence to a judge, the judge decides whether it is a breach of contract or not, and this creates a reliance on a third party, where a smart contract only relies on the code for a credible, essential contract to go through. Smart contracts are essentially the building blocks of what are called decentralized applications, which connect to the blockchain through smart contracts. So if you can imagine 2 gears, which one gear is the blockchain, second gear is decentralized applications, and you put the central gear in for smart contracts, which allow both gears to turn. This is able to be created through what is called a distributed virtual machine, which is essentially that every single smart contract in existence is stored on every single node running the blockchain for the specific cryptocurrency, let it be Ethereum. So every single Ethereum smart contract is stored on every single Ethereum node, so that when you do run the smart contract, it is run on every single node. So let's say in a regular instance, you have a client, let's say you have a regular website. If that website goes down, you're only able to access that website. But in a distributed model, if one node goes down, you still have millions of other nodes running your website. So it greatly reduces these server outages. And one of the most basic smart contracts is the exchange of funds, being able to exchange value between another person without having a third party determining the legitimacy of the transaction. First, we have Ethereum, the biggest player, launched in July 2015. And the major goal of Ethereum is to become Internet 3.0 in that you use the blockchain as the back end. So essentially, the way regular internet works is you have a client, which is your computer, and you request a website from the server, which is just one centralized model. The way Ethereum wants to essentially build on the internet is make it a way so you have the entire network of computers running the Ethereum essential software being your backend to extremely reduce the downtime. Ethereum is by far the most popular. Ethereum is by far the most popular platform for the development of decentralized applications. Over 250, almost all of initial coin offerings are essentially built on Ethereum. Yeah, go now. Essentially, yeah, you could say that. The way more so is that instead of having a single or maybe like 4 servers as your backend to run code on, you have the entire Ethereum virtual machine, which is a connection of like essentially millions of computers running the software. Yeah. Ethereum uses a proof of work, proof of stake hybrid. As we, proof of work is essentially mining. You create new blocks, verify new blocks, create new coins through mining. Proof of stake is another way of verifying transactions, but it uses staking of coins, which means the creator of the next block is not determined on who solves a certain puzzle. It is determined based on how many coins you have staking and the age of those staking coins. So essentially incentivize users to secure the network by setting aside like X amount of coins for X amount of time. And while Bitcoin has a 10-minute block time, so every 10 minutes, the next block goes through, the next transactions are verified, Ethereum is much faster, only 12-second block time. One of the big reasons why Ethereum is moving from proof of work to proof of stake is because of a essentially a huge hack in one of Ethereum's decentralized applications, which was the DAO, which is a decentralized autonomous organization, in which I think about 10% of all coins was stolen from this application. So Ethereum hard forked essentially, which moved the coins back to their original holders. This was very contentious because it changed what's supposed to be immutable, which is the blockchain. But one of the other arguments was that if they did not move these coins, then in a proof of stake system, this person would have so much power over the network that they just didn't want that to occur. All right, next up we have NEO, launched June 2015. And NEO's goal is essentially to be the creation of a smart economy, which is the combination of digital assets and a digital identity. This essentially, how do I phrase this? So essentially a smart economy is in that like every day transactions are not really, okay. So you know when you go on a website, you have terms of service or whatever, and it essentially is enforced by, like if you breach terms of service, you have a third party. It's the same thing, except that you don't have the third party. You have the smart contracts enforcing these rules. NEO uses a modified proof of stake system to verify blocks, which is called delegated Byzantine fault tolerance, which is essentially you delegate the power to validate transactions to certain players in the ecosystem called bookkeepers, which if you have, okay, so if 2/3 of the bookkeepers agree on a certain transaction, then it goes through. So in this case, it honestly contributes to centralization because if you have everybody delegating it to only like maybe 5 bookkeepers, then you have a massive increase in centralization other than proof of stake, which means everybody is constantly essentially grappling for the chance to be the validator of a block. NEO is able to scale up to 10,000 transactions per second, which is extremely huge in cryptocurrency. I think Ethereum isn't considered very fast, and it only does 30 transactions per second. So this is a very big development. And yeah,
Talking about is the theoretical aspect.
this is theoretical, yes. And one of the interesting things about Neo is that it is only divisible down to 1. And for Bitcoin, you can have a tenth of Bitcoin, a half of Bitcoin, but Neo would only base 1 Neo. Last up, we have NEM, launched March of 2015. And while NEM has been developing towards like the greater distributed network, it has really been picked up by a lot of enterprise players who seek for to use smart contracts to validate like authenticity of certificates or certain like identities. And the NEM uses a protocol called proof of importance, which really, as you know, like not many day-to-day people use cryptocurrencies. They buy it and they hold it to essentially make a profit. NEM incentivizes people to use the network by choosing who gets the block reward for the next block based on how many coins they have, regular staking, and B, how often they do actually use the network, which is very interesting. This is created through what is called harvesting, which you need about 10,000 XEM, which is the NEM currency, to harvest a block. And NEM is also moving towards usability. They don't want to be theoretical. They want to be actually used in everyday, essentially, use cases. And yeah, I think that's it. Any question?
Yeah, heard all these frequencies type of things. These are all sort of like mining discussing. It's a way for all the people in the narrow it down to one true state of us. So there's a lot of game theory and things that go into what I call consensus mechanism, so that everybody is on the same, everybody has the same record, and everything is consistent.
Yeah, this is interesting. Mm-hmm.
About an idea or a way of transacting.
Yeah. Yeah, no problem. Any?
What's up, guys? I'm Robbie, and I'm a trader, and I'm gonna sit because I need to be using this. So I don't know how many people were here last week, but I did a little bit of a different presentation. Could I just get a raise of hands on who started? How many here are traders? Who owns cryptocurrency and has it on an exchange? Okay. Did you guys start 2017 and later, or before 2017? Later, after 2017. Okay. So you guys, who trades against Bitcoin and who trades against the dollar? Against the dollar, raise your hands. And against Bitcoin, raise your hands. Okay, cool. So be more like him. And I'll tell you why. It's because basically everything is tied to the Bitcoin price. You can only get Bitcoin, or excuse me, you can only get altcoins by going through Bitcoin. I'm sorry. Yeah. Oh, okay. Well, I can just move everything off, and then it'll be fine. I'm just trying to find my presentation from last week, and then
Is anybody interested in investing? This is the guy you want to listen to. He knows so much about it. I mean, I've just been really interested in the technology. I found out about it and I just bought and I never traded or anything. So I have a lot to learn from it.
All right, so I'm not sure where my other presentation was, but we can just get to.
I can ask a question while you're searching.
Oh, absolutely. Go ahead.
I understand that there's different exchanges. It might be like
So it depends. Part of what I was going to show you guys that I might just have to bring up is the different kinds of exchanges and what they're good for. So you have GDAX, Bittrex, Binance, all these different exchanges that are kind of good for different things. So I like to personally trade certain things on certain exchanges, other things on other exchanges. Typically what you want to do is search for the most liquidity. So you want to go where the volume is. And that means that where the most people are trading, that's where you want to be. One sec. Right. So, the other thing is I trade mostly based on technical analysis. A lot of people trade technical analysis, fundamental analysis. I like the color red, so I'll buy when it's dumping. I mean, it doesn't matter what you trade off of. Every time you buy, it has a 50% chance of going up, 50% chance of going down. But the way to trade is to notice trends. So that's all about pattern recognition. And every candle, every data, every trade that happens in a market is going to influence the market in some way. It's going to have either a bullish signal or a bearish signal, bullish being going up, bearish going down. And all these different bullish and bearish signals contribute to the price of the market. So basically, every trade exists and every trade has an influence, but obviously varying strengths. So there's different ways to trade that. Based on news or technical analysis would be geometry, math, just pattern recognition based just off price analysis. Yeah.
I was just gonna ask, like, what will be?
Yeah, so that's technical analysis. Fundamental analysis is news. So news or yes, that as in addition to just the fundamental how the coin is built. Okay, so there's a lot of scams out here. There's Ponzi's, there's different types of scams, different types of fundamentals, and they can have varying strengths or weaknesses. So one way to trade all that is fundamental analysis. Look at the white paper that you're trading. Look at the website. Like, know as much about the coin as you can. The other way to trade is you can see a chart and you can know whether it's a good buy or not knowing anything about the coin. That's technical. So the best way to trade is use both, but you only have so much time, and you're using trades for different purposes. So you go back and forth. What you want to accomplish. That being said, I have a list of coins that, if you were here last week, we kind of just came up with a list of coins, and I'm just going to dive right in on different indicators, price analysis, supports, resistances, and ask as many questions because everyone's going to have so many questions. But I'm just going to kind of explain what I do when I chart a coin, how I can use that to trade and ultimately make money. So Ripple. Yes. Yes, I'm sorry. I'm getting it right now. Like as I'm talking, I had kind of a trouble finding it, but here you go. So okay. This is Aggie. So this is a platform that I trade on. It's an API platform, so you have to use your other exchanges where you actually perform market trades and such. And then this is a resource where you can integrate those exchanges and then trade off a bunch of different exchanges all on this one platform. Aggie, the word coin, I-G-I, or I-G-Y. So this is Ripple against the dollar. We're going to start all the way at the beginning so that you can really look at the market cycles that took place. So basically, you're looking for larger trends and then contain inside them smaller trends that identify the larger trend. And this can scale infinitely, going down to a 1-minute chart. We'll be looking at a 10-year chart for when we get there, but all these little trends are going to make up a bigger trend. So basically what you want to identify is the strongest trend. And there's a bunch of different ways to do that. One big thing that you hear in cryptocurrency is parabolic movement. And that's after you break trend lines and you break certain supports and resistances. So even before, you can see that there's a bunch of different things contained in here. You have a support line right here, resistance line right here. And once again, ask questions. So it doesn't matter how basic, just keep asking questions.
What is a support?
Okay, so yeah, so supports and resistances are wherever you have an indecision in the price of a market. So basically where prices are going to be pulled or pushed from, or pulled to or pushed from, almost like a magnet. So you have these supports and resistances placed usually by what's called a market maker, and that just is the person with the most Ripple or the most Bitcoin or the most Ethereum trading on your platform. So the market maker is going to push the price of the coin to each support and resistance. And to identify supports and resistances, you look for where price has either established a point where it isn't going to fall or it isn't going to break until it has ultimately succeeded that support or resistance, and then it makes a pretty dramatic move. So yeah.
So if support is kind of based on overall line, first of that,
Yeah.
the highest one is like
Yes. However, you never want to think of it as a point where it can't cross. You want to think of a point where it's difficult to cross, but as an obstacle. So once you've overcome that obstacle, you have until the next resistance to fly, right? So that's really what happened on Ripple. Now that I'm seeing this, we're going to talk a little bit more about supports and resistances before we get into something like Ripple. This is metal. It's listed on Binance. It really identifies supports and resistances going all the way back to the time it was listed. So you can identify starting all the way. Okay, so you can see just tracing all the way back from the beginning when this was listed. We're in free fall or free fly. I mean, here you never have support or resistance established, so you don't know where it's going. It hits up here, bounces around a little bit, and finally begins what we call consolidation between this support and this resistance. The way you want to identify supports and resistances are closes of candles, not tails of candles. So last week we talked a little bit about the anatomy of a candle. If you want to look at just one, let's see what's a good example. Take this green candle, for example, right? You can see this bottom. Right away we know it went up because it's green, right? So this bottom is the open of the bottom of the body. The bottom of this tail, right there, it's kind of hard to see, I know, on the big screen, but the bottom of this tail is the lowest price it reached that day. And we're looking at daily candles, you can see up here. So each of these bars is 1 day of trading. So the reverse is true. So this up here is going to be the highest point it reached during the day. This is going to be the close. So you have bottom, open, close, top. Yeah.
So it kind of works like
Exactly. So you have the majority of trading happening between these marks, and all these, there's many different kinds of analysis. So you can dig so deep into analysis of a market where you can be identifying each individual candle, and you can try and pick when candles are going to reverse, and such and trade all these different things. So getting back to kind of a encompassing support and resistance representation here and here, we have consolidation. Now you can see there's different, it breaks these lines different ways. So obviously once we broke this line in this market, we had a free fall. You can think of these lines almost as checkpoints where, you know, if you break here, you can almost be sure you're going to fall to here. You break here, you're almost sure you're going to be falling to here. And then once you break a point of no other support, so like an all-time low or something that never really established much support, you're really in free fall. And that's what happens to a lot of these cryptocurrencies is they fall with no bottom and they go all the way to zero. You got to be careful about that. So here is a really good representation of support and resistance. And these are identified by horizontal lines because the y-axis is representing price. Does that make sense?
So the yellow is support.
The yellow, right? Okay, so this yellow is an all-time low maximum. Not an all-time low because you see it drop, but there's what's called capitulation, which is where basically the market has no hope. But that's the best time to buy. It's funny to hear that, but really it is. So when you see, and that's identified by, as I was saying before, parabolic movement downwards. It's not so apparent here, but if we go back to Ripple, you can see where's a really good right here. You see right here, massive, just there's, if you see this coin here, you're going to think there's no hope. There's absolutely nothing that can help it except for just the eventual bottom. So when you see something like this, it's called, and you're looking to buy, it's good when you see that. Okay, let me start over. So this line right here is from this low. And this was the all-time low previously to when it hit right here. So when it breaks the all-time low, that's your signal as a stop loss, some kind of, getting out point, because it really has no bottom at that point. What's called catching the knife is buying something that's in absolute free fall. And you want to limit yourself to that as much as you can, because if you try and catch things that, have no bottom, you could be in free fall for a while. So when you're looking for entries, the best way would be to look for things that broke support, reestablished support, identified right there, and then enter your position. So in this case, and these things are called throwbacks when this happens. So basically what happened is you have free fall, a throwback to here. So now the next candle that comes into play is going to be a decision point. Are you going to break up or down? Are you going to break this resistance and establish a new support? You're going to break down, continue free fall. In this case, it broke up, established support right here. And then obviously Ripple did what Ripple did. So, yeah.
I've also heard on a couple of deep analysis.
Yeah, that's a pretty advanced indicator. There's millions of different ways to trade. People, if there's a full moon, people enter a long. I mean, there's it doesn't matter what you use as your reasoning. If it works for you, it works for you. Some people are gonna love supports and resistance lines and trend lines and price analysis geometry. The other method of trading you could do just based off indicators, volume, so many different things. I can't hope to cover them all, but I do know about wave analysis. It happens to be kind of new, so it doesn't have a lot of support, just like it hasn't worked for that long. It is, I know it is working recently, the people that have used that, and hopefully we can get into that later, but I don't think we're ready to get into that now. Yep.
So you personally have figured what, how often do you like hit whenever, let's say you buy, since they're so popular and everything, but usually the higher the volume, the more
Mhm.
there's more trading occurring. How often do you look at the price? Like how often do you go there?
Yeah, I would say. Oh, how often do I go in there to check?
Well, yeah, I mean, like, you know,
Yeah, I mean,
because like
I'm happily obsessed. So I mean, I personally like to check as much as I can, and there's a few different reasons for why you check as frequently. It's almost good. You don't want to overtrade, and a lot of people say that. So in times of high stress, I would say limit how much you check.
yeah, that's what I was going to get at.
Okay.
Like if you're like emotional, really emotional, then you like you can just completely screw up something.
Absolutely, yeah.
You know, you're triggered by like fear or something. The market goes down. There's a lot of like pessimism in the markets.
Right. And the two biggest things you hear about with that are going to be FOMO and FUD, and pumping or crashing a price, and that's purely emotion. I mean, fear of missing out is what FOMO stands for, and that's just what happens when a pump is happening and you think, wow, this is going up in price, I want to get some of that. But really, you should have bought it, a week ago when capitulation happened, there was parabolic movement down, bottom hit, now you missed out on like 200%, but you got in because you FOMO'd, but then it crashes and you lose 50%. So like, you want to limit emotions as much as you can and be tracking market cycles so that you know that you didn't get what you thought was a good entry, but really you missed out on, all that movement that happened earlier. So yeah, okay, so getting back to this chart, we can identify actually each part of this chart going back to the beginning. So this right here is called a downward, it's a descending wedge. And there's different reasonings why this is bullish. Basically, it's continued movement downwards, and you want to see this paired with lots of positive buying volume when this happens. And you can see that happened the first time the volume. Oh, by the way, I don't know if we haven't actually talked about like the anatomy of a chart. The bottom part right here is all volume, and this is a volume oscillator, so it's kind of a mean of this volume. And well, just the price going up and the time going back. So this is a 1, 2, 3, like a 4-month chart going back, but it evolves, and this platform happens to be dynamic. So you'll see the candles adapt over time when you zoom. So, okay, so getting back to the price analysis, this descending wedge basically showed that you have a range that the price is going to be fluctuating. And then what you want to look for in a market is always consolidation. So in the other chart I showed, it was horizontal consolidation. It's just price getting nearer and nearer to a mean, getting closer and closer to a mean, where eventually that mean becomes the support and the resistance, and the market has to choose whether or not it wants to go up or down, because there's no more supports and resistances to bounce off of. So you can see that basically here you have these two lines getting closer and closer to each other, support, resistance, price bouncing, 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 until eventually broke here, established it was going to go down until it reached a bottom around here. It moves into a cup formation coupled with high volume, bullish, but doesn't break some of the previous resistances it had before. And you can see that, periods of good support. So right here, it established support with these 1, 2, 3, 4 candles right here. This support right here was the peak of this price. So support and resistance often flips and becomes the other one. Happened right here. So you see when it comes down, this was established as support, broke it, but then eventually, and the ranges aren't going to be exact each time, but this is called the throwback when it goes and establishes this support, this previous support as resistance. Yep.
Are most of all these lines done by yourself, or these are kind of pre-done?
Okay, so I drew all these lines, and it's difficult to recognize at first, but you pick it up extremely fast. So my suggestion would be everyone get on TradingView, get on CoinAggie, get on the platforms that you want to get on, and just play with all these buttons over here. Google the ones that you want to know more about. Come up to me and ask more about the ones you want to know about, but just get experienced on the platforms that you want to use. Yeah.
When did you draw, or for example, when did you start drawing that from?
Okay, so yeah, so I happened to do this chart like 2 days ago. But it doesn't take away from the value that market cycles repeat. So if I had just looked at this and I drew this, I would have, not that I would have known, but I would have had a kind of insight into knowing that a descending wedge was coming, and look what happened. Okay, so history tends to repeat itself, and this is just one complete market cycle for Ripple. It's been like, this is a 4-month chart, 4 to 6 month chart. Stocks have been around way longer than cryptocurrency has. So if this is really here to stay, you're going to have a lot more information to track market cycles. So the fact that, if I drew this chart 2 days ago and then, I didn't really get to predict anything with a trade, but going forward, it'll provide much better analysis and, give me opportunities going forward. Other things that you want to look for in charts. So these 2 circles right here, there's not much that is apparent in circles except for they happened both within a descending wedge, both what's called a double bottom on these 2 candles. So capitulation, basically in free fall, once it breaks support, an automatic pump back up. It's called a double bottom. Bullish, signal of a possible short-term bottom, and you see the same thing happened over here. So there's possible reason for concern looking at Ripple. You could see this as a possible repetition of market cycle if it breaks this blue support, or you could see this support line as a possible buying opportunity and, maybe use a tight stop loss. But that would provide some sort of support, just an analysis based on previous price analysis, using that as trading opportunity. Within here, okay. These periods of what's called consolidation is just price bouncing off support and resistance, trying to find a mean. This happens. This is what you want to look for every time something goes up a lot, goes down a lot, because it has to return to a level price. Do you have a question? No. Okay. So yeah, when you look for these periods of consolidation, it's what's called chop. So it's basically chopping between support and resistance. And you want to try not to trade chop because you want to try and trade with trends. So you want to trade once a trend is identified, and this is where no trend is identified. If you're here on September 14th, you have no way of knowing where this is going to go because it's right in the middle of this previous pump. It's still working off this trend, trying to find a price, and you don't know where it's going to go because it's just going to continue sideways until it breaks one of the established supports and resistances. It eventually breaks downward. This yellow arrow is just showing a throwback to a support line right here. So it breaks this support, falls very deeply, which you can see as this tail right there. Kind of hard to see, but it's right there. And then throws back to this support line right here. Now it switches. Now it's saying this support is now resistance. So for me to continue upwards, I'm going to have to break the support. Now, the more and more times it bounces off the support or this resistance, the stronger it identifies itself as. So it's going to be tougher and tougher to break the more times it bounces off. It eventually breaks downward through more support. You can see another throwback right here. Through more support, a throwback to the inside of this trend line, and then eventually massive capitulation right here, where the people got the best buying opportunity. Yep.
How do you establish that middle arrow, that support line right
This one?
there? No, the second yellow arrow.
This one.
Yeah,
This.
yeah, that one. How do you establish the support line there?
Okay. So you see how this peak and these peaks are about the same. You can see sometimes it's hard to identify, but you can identify weaker trends and stronger trends and use those as part of a bigger trend, ultimately deciding whether or not you want to buy or sell. So you had a little bit of consolidation right there. You can see sideways movement. And that's the same as up there. So this is Ripple. I'm going to go through a few other different charts to cover some other aspects, or are we running out of time?
Yeah.
Okay, sorry. Questions or things that you guys want to see? Yeah.
How can you trade on Bitcoin?
Like against Bitcoin and not against Ether?
Yeah.
Okay, so I like trading against Bitcoin. I actually love trading against Ether. I don't like trading against the dollar, and that's because, well, there's a few different reasons. Tether is a big problem, so you don't want to be trading with Tether because they're, currently being involved in some accused fraudulent stuff, so you want to try and stay away from them. I like to trade against Bitcoin because it has more analysis. So all these US dollar markets weren't really ever available unless if you're trading the altcoins. If you're trading major exchanges or major coins like Bitcoin and Ether and maybe Litecoin are really the only three. You can trade against the dollar because they have enough analysis that they have enough price history where you can analyze, get a good understanding of what kind of cycle it's in. The rest of the coins just aren't at that point yet. Also, because everyone has to go through Bitcoin to get altcoins, that's becoming less of the fact, but that's still pretty prevalent. And the fact that everything is basically tied to Bitcoin that way, you need to have an understanding of how that ties back to Bitcoin. So price trading against Bitcoin is going to be the best way to do that.
How do you decide against
Okay, so I would trade Ether against Ether tokens and ICOs, and I would trade other altcoins against Bitcoin.
When you say trade against, what do you mean?
You see up here in the top left, it says XRP/Bitcoin.
So it would be the value of the whole.
Yeah. So over here in the price, you have a bunch of zeros and you have what's tied to the Bitcoin price. If I pull up against the dollar, chart looks a lot different, right? So this is going to be just the trends are going to be completely different, and it's going to give way to different things that are going to lend. It's going to signal different opportunities that aren't necessarily the strongest trends. So you want to identify the strongest trends because that's where the price is going to go, which is why I trade against Bitcoin mostly. But Ethereum performing the way it is, And since all these tokens that are developed on top of Ethereum's platform basically utilize Ethereum, they're tied to Ethereum. They're not tied to Bitcoin, which is very good to trade against Ether that way. Any other questions?
Not financial advisors.
Yeah.
Yes, so we
Do your own research.
Is just ideas for ways that you can recognize trends in the market. Not telling you about it. Exactly. So you just want to inform people about things that topics that are involved in testing.
Yeah, absolutely.
So thank you.
Yep.